the change that we're seeing now is enormous in scope, and it's a once in 100 year change. And the sooner you understand that, and the sooner you create the space and the capacity to entertain the kind of change and the kind of outcomes that we simply haven't had to think about or deal with for most of our adult lives, the better equipped you're going to be to try and figure out on the fly how to navigate your way through it.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The pace of change in the world order has accelerated notably in 2025. The era of globalization is being fast replaced by nationalism, protectionism, and a shift towards regional trading blocs. In America, there's suddenly a recognition that runaway deficit spending in the accumulating pile of debt and unfunded liabilities is an existential problem that needs dealing with. So, how are these accelerating developments changing the outlook for the future? For insight, we're fortunate to welcome macro analyst and interviewer extraordinaire Grant Williams back to the program. Grant, thanks so much for joining us today.
Adam, always a pleasure, my friend. It's lovely to see you. How you doing?
I'm doing great, and it's great to see you too. And as we jokingly said before we turn the camera on, I'm not sure what we're going to talk about. It's been such a dull year so far.
Well, and as I said, and I wasn't joking at all, we could talk about soccer for an hour because we had a fantastic Champions League semi-final last night. I could talk to you about that for hours, keep everybody entertained. But
Well,
I
you know what?
suspect
I
we have
think
weightier matters to get to, probably.
we have weightier matters, but I'm suspecting that maybe the majority of the audience here would love it if I just said, "Sure, let's just talk about the
Let's
football
go.
game." All right, but to what I said there in the intro, there does seem to be an accelerating sea change underway in the
Yep.
global world order, and I think you can kind of make arguments on both sides. You could say, look, a lot of this is addressing sort of long-term unsustainable trends, and whether that's the way geopolitics and economic relationships between countries have existed for the past several decades, or whether it's the way in which America and other nations are starting to do some house cleaning here, right?
Yep.
So I guess without asking a leading question on the good or bad side, just how is this changing the calculus, if at all, in terms of your macro outlook from here?
Well, it's interesting because your point is absolutely correct. People spend an awful lot of time trying to figure out the nature of this change and the driving forces behind it. Um, that to me is wasted energy. It doesn't matter why. This is change, and this is not necessarily change that's driven by this policy or that policy or Donald Trump or Xi Jinping. This is the kind of change that's much bigger than that, I believe. Um, and because of that, it doesn't really matter that Trump is in the White House right now. It doesn't really matter that Xi Jinping is in Beijing. It doesn't really matter that any of the players on this kind of geopolitical chessboard are on the squares they're on. These cycles are enormous, very long in nature. I was listening to an interview recently with a guy talking about how this is the end of a 5,000 year cycle. Um, and there are all kinds of cycles, but a lot of these cycles have been identified over the years of differing lengths. And it just happens when you do overlay these. So there's a war cycle, and you can look at Kondratiev cycles and debt super cycles, and if you overlay these cycles, there are plenty of overlays that show that a lot of them come together around now in this last um, 10, 15 years and into the next 10, 15 years. And you throw into that the framework of your last guest and my most recent guest on my podcast with Dimitri, Neil Howe, and this idea of a fourth turning. And it's very difficult not to come away with this sense of real change. And I don't mean Democrat to Republican, and I don't mean low tax to high tax, and I don't even mean globalization to localization. We're talking the kind of secular change that only really occurs every couple of generations. So it's very, if you take Neil's framework, for example, you've got a 1 in 4 chance of being one of the generations that live through these times. And that's 100 year cycle. So you've got 1 in 100 years of a chance to actually be living and trying to operate in the times we're in now. And because of that, it means that this change is completely unfamiliar to everybody that's going through it. They haven't lived it. They may have read about it. The lucky few have read about it.
Mhm.
The luckier few still have maybe talked to their great grandparents when they were alive, or the grandparents when they were alive. But those generations necessarily are all gone now. So the visceral memories of these periods, the periods past, is all gone. They live on in the stories. They live on in the history books. And of course, um, you don't have to go searching for stories from your grandparents, but you do have to go searching for stuff in history books that's not presented to you. So if you're not interested and curious and keen to understand this stuff, you're not going to, because it won't be fed to you. And that's where I think we are. I think we're in one of those periods, and so the change that's happening is going to feel incredibly uncomfortable. It's going to be terribly confusing. It's going to be significant in its scope and its range, and it is going to affect everybody. And when you have change like that, the difficult part is trying to find a way to step far enough back from the daily noise and the on the ground change that people are seeing in their portfolios, and the way stocks perform and the way currencies are moving. You need to step much, much, much further back to be able to see that those things are a tiny, tiny part of the change that's going on. And it's not the change in the stock market are not going to affect the broader changes. The broader changes are going to affect the stock market. So the
Okay.
better handle you can get on those, and the better understanding you can get of them, the better chance you're going to have of being able to navigate your way through it from an investment perspective. And that's, again, another important point. That we have put the stock market and asset markets at the center of our universe for multiple decades now. It's all been about the stock market. It's all been about the bond market. It's all been about um, you know uh, your performance every year and how much money you're making and how much you're compounding. It's been all about that, and that is another big change here. That's It's not going to be irrelevant, but that is going to be driven by these big changes, and you are going to see things happen in the financial world that seemingly make no sense because you're judging them on the last 40 years and how such and such an item of news would have impacted things 10 years ago, and suddenly it's not. And that's going to be difficult for a lot of people. So I think I don't want to get on the soapbox, but I think the important thing for people to understand is the change that we're seeing now is enormous in scope, and it's a once in 100 year change. And the sooner you understand that, and the sooner you create the space and the capacity to entertain the kind of change and the kind of outcomes that we simply haven't had to think about or deal with for most of our adult lives, the better equipped you're going to be to try and figure out on the fly how to navigate your way through it.
Okay. Fantastic opening. I will. I'm hoping we can kind of dig in a little bit into what you personally feel you have confidence in predicting versus areas where you just feel like, look, nobody knows. To your comment there about us both recently interviewing Neil Howe, Neil said in my recent conversation with him, he's like, look, we don't know. We don't know how this thing is going to unfold when it really breaks into the breakdown of the fourth turning that then gets replaced by the first turning, and we yet don't know if it's going to be some sort of internal crisis, an external crisis, maybe a mix of both. And to a certain extent, he's just like, so to me, I'm not trying to predict the unpredictable. I'm just trying to plan for what I know is going to happen, or I have high confidence is going to happen, which is disruptive change, right? So he's working on a new book that is basically about developing personal resilience, right? It's like, look, I'm not necessarily here to tell you. I mean, he did his best job of saying, hey, here's what I think is a good long-term strategy of assets I think will probably how they'll perform over the course of the rest of the fourth turning. But how we get from here to there is going to be anybody's guess. But so he says in the interim, I'm kind of long personal resilience, just like try to invest in the things, not just financially, but across the rest of your life that will act as shock absorbers to this volatility that this change is likely to bring. Um, so I, I guess one question I have, and maybe it is unanswerable at this point, Grant, but If you talk to some people, they'll say, "Oh my gosh, it's the dissolution of globalization and countries cooperating, and we're going to get into this protectionist, mercantilist world, and it's going to be, smaller pieces of the pie for everybody, and that's going to be bad." If you listen to the administration, they're saying, "No, the change that we're engineering is a new golden era, at least for America." And you can make an argument that if Trump is successful on the economic policies he's putting in place, yeah, maybe it gets us to a new golden era, or even if it doesn't, maybe it just buys us more runway, another decade or more before the reckoning of the stuff that you and I normally talk about, Grant, comes to pass. So, given your read of the current maelstrom of change that's underway, uh, uh, which parts of it do you feel you can point to and say that's actually pretty good progressive change versus no, that's actually pretty destructive change? Or is it too early to call balls and strikes like that?
Yeah, it's a great question, Adam. I think the first thing to understand is when the guy who literally wrote the book doesn't know,
Hmm.
right? We should all get comfortable with the fact that we don't know and we're not
Yep.
going to know. And that's a really important thing to understand because what you just said there speaks to this, that we all have this need to to bring order to chaos. We all need to have a framework to help us understand everything. And we're very willing to accept any explanation rather than the chaos of the unknown. Every morning you will see, you know, um, markets fall because X, and it will be one thing: markets fall on Apple iPhone sale numbers, right?
Right. We're
Um,
not rational beings, we're rationalizing beings. We like
yeah,
to, yeah.
exactly. Great way to put it. And so we grab onto that like a life preserver. Oh, okay, that's why the market's fallen. Okay, I don't have to worry about anything else. That's what it was. I don't have any Apple shares. I'm fine. I don't need to worry about this. Um, so this idea of disruptive change and destructive change, again, coming back to Neil's framework, the fourth turning is a point in time where institutions are torn down, as he said. Institutions in which we've lost faith and we've lost trust and we believe are no longer fit for person are torn down. I mean, that is, by its very definition, destructive change. And, unfortunately, at the end of these cycles, the change has to be destructive because the kind of incremental change that's happened to bring us to this point has gone through those turnings. It's been from the last teardown. It's been here's how we make things better. Here's how we make things better, and then we get to the point where the system's working, and then we get to the point where the grift and the corruption start happening. People take advantage of the system, and then the trust starts to evaporate, and then you have to tear the stuff down again because you've reached the point where it's no longer fit for purpose. So the change is going to be disruptive. Destructive. I feel very confident in saying that. I don't know for certainty because none of us know. We're all talking about the future, but I feel very confident that the change is going to be destructive, and it needs to be destructive because there is an awful lot going on with the system right now that we'd all be better without. So on that personal level, Neil talks about building personal resiliency. Um, Again, this is another cyclical thing. You have a generation that come out of the war, the baby boomer generation, who were very much peace, love, the hippie generation.
Mhm.
Everything was it was all about we don't want responsibility. We want to be
Right.
free.
The,
We want
the
to be
me
free beings.
generation. Yeah.
They raised my generation, the Gen Xers, who were forced to take personal responsibility because no one look after us. Our parents were all hippies and they were all out there enjoying free love and God knows what else. So we had to have responsibility, and the Gen Xers out there listening to this will know, and I don't think any of us would have it any other way. We wouldn't have wanted the boomer childhood. We wouldn't have wanted the millennial and Gen Z childhood. Our childhoods were characterized by freedom and personal responsibility.
Yep.
Um, and no seatbelts, and parents smoking in the car. We rolled up windows and all that kind of stuff. But it did give us a sense of personal responsibility. We then took that to our kids, the millennials, and we became the opposite. That's where helicopter parenting began. Um, and then that led to the millennials. And here we are again in the cycle where the millennial generation, and I'm not being pejorative, I know many members of the the Gen Zs, sorry, who are terrific and very unlike the stereotype description of Gen Zs. But uh, there is a seam running through Gen Z who have grown up in the best times really mankind's ever had in terms of peace and access to capital and technology and all these things. Now, yes, we can go into the fact that they can't afford houses, and we can get into the boomer Gen Z thing, and there's a lot in that. But ultimately, their generation is again not necessarily about personal responsibility. It's about having a good time and traveling, and we can't buy a house, we can't raise a family, so we're going to have experiences. We're going to do, and you deal with the cards you're dealt. But what that's meant is that a lot of these institutions, their trust in the institution, the system in which they've seen their grandparents and their parents grow up, have a family, buy a house, settle down, is not available to them. And you can sense that loss of trust in the system amongst Gen Z, and with good reason. Once that trust goes, uh, it takes destructive change in
Mm-hmm.
order to bring that trust back. And so for the Gen Zs and to some extent the millennials, because that trust has gone, um, they're going to be the ones who will tear these institutions down because they want to rebuild them in a way that's fit for their purpose, and quite rightly so, which is exactly what the boomers did after World War II, right? They tore down the institutions, they created
Yep.
the United Nations and NATO and IMF and the World Bank and all these things that were going to make the world a better place. And in that passing of the torch politically from a generation of boomer politicians. Once again, Gen Z is going to get skipped over completely here. The next generation of politicians are likely to be millennials and
Yep.
maybe even a smattering of Gen Zs. Um, they are going to tear down the institution which has, in their eyes, benefited the boomers. And they are going to redesign it and reimagine it in a way that is fairer to them. And that's not going to come without pain. It's going to come with what is necessary to redress the balance, which is a redistribution of wealth from the generation that the last 60 years have benefited, which is boomers first, my generation second, the Gen Xers, and redistribute that wealth fairly to the younger generations. And that doesn't have to be the fact that they're going to take your money away and redistribute it, though that could happen in some ways. Russell Napier's capital repression theories come into play here. But think about the simple idea of cutting house prices in half. You know, let's say you're a boomer with two or three homes, and the price of all of them get cut in half. You know what? You are still a long, long way ahead in what you paid for that house, but now suddenly it's affordable for two new generations of home buyers who haven't
Mm-hmm.
thus far been able to get on the ladder. That kind of legislation is the kind of thing that we're going to see. Wealth tax on homes or one-off taxes on homes, the means through which to bring house prices down. It's just one example of the kind of change that if Gen Z and the millennials are going to redesign institutions, that's the kind of thing they're looking to do. Um, But Neil said something to me when Dimitri and I were talking to him a week or so ago. We talked about this, and I was asking him about the institutions being torn down, and he said something to me that stopped me in my tracks because I hadn't thought of it until he said it, and as soon as he did, and since he did, I've been able to think of nothing else. And I talked about NATO, saying we're seeing this institution that was born out of the end of World War II. We're seeing it literally being torn down. We're seeing the Americans say we are going to pull out, and on the back of that, the whole thing crumbles, and everyone's scrambling around to try and hold it together. Maybe it doesn't hold together. Maybe we get a European defence organisation. We don't know.
Yep.
But when I talked about that, Neil said, you're right, and it is characteristic that these institutions get torn down. But is it possible you're thinking about the wrong type of institution? And I said, what do you mean by that? He said, well, What about the US Constitution? And I stopped for a moment because it took me a second for what he said to kind of percolate my inches thick skull. And and it hit me like a ton of bricks, right? Because in America, there is nothing more institutional than the Constitution and the Bill of Rights. They
True.
are fundamental to what America is, what it has been, and what it represents.
Right. And they have
And
persisted through a number of fourth turnings. Yeah.
persisted, exactly right. And if you think about what's happened recently, and this is not an anti-Trump rant before the comments start flying in capital letters, but we've had in the last month, we've had Donald Trump say, yeah, I'm going to run for a third term. And he's selling Trump 2028 hats on his merch store, right? And we've also had him say in the last week, I'm not sure if I need to uphold the US Constitution. And yeah, don't take him literally, take him seriously, don't take him seriously, but take him literally, whichever way around you want to come at that. The point being, uh, the fact that that stuff is being said, whether it's meant as a joke or not, must put in your mind this idea, well, what if? What if he did run for, how could he run for a third term? Well, FDR had 3 terms, so maybe there is a way to do it. What does it mean if the president of the United States says, I don't know if I need to uphold the US? What does this stuff mean? These are things that would never have been said before. And the very fact that they are being said is demonstrative of the fact that we're in a place where they can be said. And that means that these institutions are not as strong as they were. Now, I'm not saying the Constitution's going away. I'm saying that we have to think about whether it's under threat. We have to think whether it is as sacrosanct as it was before. And the answer could be yes. And I hope it is. But these are the kind of changes that we're talking about here. These are the kind of disruptive, destructive, unstabilizing, unsettling changes that we have to think about. And putting your head in the sand and saying, Trump being Trump, he might be. He might well be. And I feel very confident saying that at the end of his second term, he will exit stage left. But for the first time in my lifetime, and for the first time since FDR, nobody can sit there and say, I guarantee you he's a two-term president, he's done. Because that element of doubt has been sown. The same way that element of doubt has been sown in NATO by what Trump said. And so Trump just happens to be the agent of chaos at this particular point in the cycle. No, this isn't all his fault. He didn't do all this. He just happens to be the guy when it all comes to a head. And I would posit that it's not that Trump's here when this is happening. This was happening, and Trump had to be here. It can only happen now. Trump's here because he is the guy that can bring the disruption that's needed to reset the system.
That's one of the things I really enjoy talking to Neil about is I use the analogy of tectonic forces when I was talking to him the other day, but he basically says that the forces of history make the leaders, not the other way around.
Yeah,
Right.
yeah.
We see these
He's
people
absolutely
throughout
right.
history and we think, oh my gosh, they really changed the course of history. And Neil would generally say, well, no. Um, the force was going to happen. It just needed a catalyst to do it. And the pressures just got big enough so that at some point in time, the right leader got thrust into the right moment so the change could then happen. Um, okay, so you've made the compelling argument that change is afoot. It is going to happen. It's the kind of change that kind of calls into account all of our assumptions, right? Things that we thought would be around forever. NATO, the Constitution, whatever. I mean, just everything is up for grabs in a fourth turning as the status quo gets dismantled, essentially. So we don't know how this is going to unwind. A lot of fourth turnings, as Neil reminded me recently, have a kinetic element to them. I think we're all crossing our fingers and hope that that doesn't happen this time, but no guarantees. So with so much unknown and the potential stakes so high, it's hard not to hear what you're saying, Grant, and think, okay, then this is a time of defense, right? This is not a time to be incredibly speculative. And of course, nobody knows what's going to happen in the markets tomorrow. Maybe we have a huge bull run, for the next month or whatever. So yeah, there might be some money to be made in short little pockets or whatever. But it seems that the wise, prudent step here would be to be looking at the next 5 to 10 years and say, look, I got to be a little more focused on making sure I don't lose what I have due to these changes than trying to really reach for gain here. Am I putting my finger on the right conclusion here?
Yeah, no, I agree, and this is something I've been speaking about for a while now, and I've become a bit of a broken record because these cycles are long, and this period of upheaval is both long and slow, but ultimately climactic, and so you have to be prepared ahead of time, and yes, you're right, Adam, that there may be some money to be made, but if you think about the amount of wealth that's been generated over the last 20, 30, 40 years, there's a lot more money to be saved. And I don't mean put in the bank and saved, I mean saved from extinction. And so, as I've said many times before, if you happen to have been invested in the stock market or the bond market or real estate or any risk asset at all, you got rich. You're a rich person now. Whatever it was you put in, you have significantly more now. And that's terrific. But if you don't change your mindset from, okay, where do I make the next 5x my money? And think to yourself, boy, I've had the most extraordinary tailwind that really anyone's had in a 40,
Right.
50-year period at any point in the history of investment, pretty much, in terms of consistent tailwinds that have bailed you out of every problem, that have enabled you to buy every dip and ultimately be okay. I saw a terrific chart on Twitter that my buddy Meb Faber posted, and it was a chart showing the longest consecutive year periods without real gains in the equity markets for a bunch of different countries. And i.e., on a real basis, the stock market went nowhere for how many years?
Hmm.
Um, the US, that longest period, and this was from 1900 to 2024, so 124 years. And the US, the longest period was 16 years, which was, it didn't say which time, but that'll be like mid 60s to the early 80s. The UK was like 13 years. There were a bunch of countries with 9 years. Austria was 90 years without real gains in the market out of 124. Now you go back to, that probably goes back to Credit Anstalt in 1931. But the point of this chart was to see, I mean, and I think the shortest period, I think I may be right in saying, was 9 years. Denmark, France, Italy, UK, every major stock market on that list, and the world was 22. So the world in 124 years, the longest period of no real returns was 22 years for the world on average. Think about that. That's an investment lifetime. That's
Yeah.
from starting in the workplace at 24, right, and retiring early in your mid 40s. Nowhere on a real basis. So that stuff is very real. Uh, we haven't lived through any of it unless you're some poor Austrian. Um, but it's very real. And so this idea that you talked about there playing defense is a very important one. The idea that gains are guaranteed every year, you just have to figure out which place to kind of park your money in to make those gains. Yeah, it has been that way. But you know what? NATO has been inviolable for what, 70 years. Um, it doesn't always, next year isn't always the same as last year. That's all I'm saying. And I think we are now coming into a period where next year isn't going to be the same as last year. And a lot of the things we're seeing in markets, with some of the crazy explosions of prices to the upside and multiples in a period of intense volatility, very much look like the kind of dying gasps of a secular bull market where everybody is jumping into the things that are making money because they feel
Mhm.
like, well, that's the next place to make big returns rather than that's the next place to compound my savings. And I'm sure we'll talk about gold in this, but this is a big part of what's happening in gold right now, I believe.
Um, okay, great. So a couple of things. One, we could have had an separate from these sort of fourth turning seculum end of cycle risks. We could have had a conversation about the uncomfortable potential for a lost decade ahead, just looking at some of the valuation charts, right? I mean, John Hussman publishes these all the time. I haven't
Yep,
looked at his
John's
most
terrific.
recent ones since the markets have come down a little bit, but not that much. But I'm pretty confident that they're still predicting um, at best a flat, if not a negative annual return for the next 12 years based upon how high valuations are right now, right? So we could have made just a purely valuation based argument for a lost decade. Then you add in all these, cycles that appear to be ending now, and it just, again, sort of it screams prudence, right? Um,
Yeah, yeah, it does. And again, Neil, Adam, sorry, your point is an important one because what we're talking about here are a possibility and probability. That there is an elevated probability
Probability. Yeah.
of that being the case. And so, at what point, at what degree of probability does it become something that you need to seriously think about mitigating? If there's a 5% chance of a lost decade, maybe you roll the dice and you don't adjust your portfolio and you think to yourself, well, it's only a 5% chance. I got 19 times that that it's going to carry on like it is, and I'm not prepared to take my chips off the table for a 5% chance. Fine. Um, all I keep saying to people when I talk about this stuff wherever I go is at least give it the thought it deserves. At least don't just say, that's all nonsense. At least think it through and work out the damage it could cost you or cause you and your family should it happen. And if you can quantify that, or at least have a sense that there would be a really bad outcome for me and my family, then it's probably time to do something about it. If you don't think it'll affect you, if markets go nowhere for 15 years, fine, carry on. But at least take the time and uh, give your capital the consideration it deserves in terms of the time you're taking to think things through.
So I completely agree with that. And I would add to that that even if you decide not to take action, you should come up with, okay, what are the markers that I'm going to monitor that would suggest to me that my base assumption is wrong and that I need to go and start pursuing a plan B, right? And this might be a poor
There's a,
analogy,
there's
but
a, you're right, Adam, but there's a danger in that, right? There's a danger in that, and that's the equivalent of saying, I'm gonna dance a bit nearer to the door
Mhm.
because if there is a fire, um, that way I'll be able to get out. And the fire happens behind you when you're not looking. Everybody behind you piles out the door, and you're stuck in the room. So, like I said, it doesn't mean you have to take everything off the table. But if you're saying I'm gonna I'm gonna look for the markers that might tell me it's time to do something, you do run that risk.
Oh,
If you say I'm gonna make my portfolio more resilient, and that you used that word earlier on, and it's absolutely the right word. I'm going to make my portfolio more resilient, i.e., I'm going to make it more defensive. I'm going to make it more robust. I'm going to give up some of the upside to make sure that I'm robust and more secure than I have been. That's dancing next to the door with your back to the wall, so you can see everything that's happening.
I'm right there with you. And I guess all I meant to say was to me, that's actually taking action. So if you decide not to do that, I think that the probability of what Grant's saying is too low that I'm not going to do anything. I'm going to keep doing what I'm doing. That's where I'm saying, okay, if you're going to be all in, if you're going to stay at the party, to use the analogy, and keep partying on, um, then just ask yourself, what am I going to look for that might indicate to me that I was wrong, right? And maybe it's the smoke alarm goes off, maybe it's the cop car pulls up outside or whatever. Um, But otherwise, if you don't do that, then you risk getting caught completely blindsided by these forces if indeed you pick the wrong one. But I'm right there with you, Grant, which
Well,
is
Adam,
you
actually,
should start
this
with the
is
resilience.
yeah, and then this is. I mean, I don't want to harp on this, but I think it's a really, really important topic for people to think about. Um, and that is what you're talking about is really important. The danger is that because we have become immersed in financial markets and we swim in financial waters looking at the world outside them, you are there's a high risk that what you think is the smoke alarm, i.e., well, whenever I've seen the yield curve invert, it means recession. So I'm going to keep an eye on the yield curve, or I'm going to
Right.
look at credit spreads, or I'm
Credit
going to look at
spreads. Yeah.
whatever it might be, whatever your financial metric is, that is your smoke alarm. To my earlier point about not standing far enough back, the kind of signals that you're going to see that scream "get the hell out" are not necessarily going to be financial. So you might be looking at the smoke alarm thinking, "Why the hell's that not going off?" Um, And meanwhile, the room is surrounded by guys with machine guns, and they're all cocking the machine guns
Yeah.
because the kind of change we're talking about, the financial markets have driven the change for a long, long time. Politics, geopolitics, cycles, time, uh, political strife, wealth disparity. These things are going to start driving finance as they normally do and should. And it's at the end of these cycles when finance becomes so
Yeah.
important that it starts struggling. So that's what I'm saying is that be very careful what you think the signs are, because I don't think the signs are going to be in financial markets and in the places you're maybe looking for them.
That's such a great point. And first and foremost, again, let me underscore, I think people should be taking action. So I'm not advocating this at all. But that point is a great one. And Michael Every, who has been really predicting and warning
He's
of
been
this,
brilliant. He's been
the
absolutely
shift
brilliant.
from globalization to
Yeah.
mercantilism. Um, he really has tried to remind people long before it's now been manifesting this, which is like, hey, in this sort of mercantilist environment, which really is how the world operated up until this new and rare and seemingly temporary period of globalization, is the government picks winners and losers economically
Yeah.
and financially because it has other priorities, right? It says, look, we're going to feed this industry and maybe starve this one for the next year or two because we're trying to affect this greater national goal. So, this sort of unfettered free markets, which really have been, kind of overly juiced markets in many ways, overly intervened in markets that we've all become accustomed to. Things may very, very much not work that way going forward, to your point. So I'm glad you made it. And just to underscore, I think the subtext of what you're saying too is we have a system. Literally, if you look at the age of everybody who's kind of watching this video, and certainly everybody on Wall Street, they've really cut their teeth and made their fortune as such as they are to date in a market where kind of everything went up over time, everything was great, finance was in the driver's seat. The vast majority of those people are highly likely to just slam into the wall of reality of this new change of whatever we're walking into, completely surprised by it. And I think your point is hey, do your best not to be one of those people, right? Like
Yeah.
don't just blindly walk into this buzzsaw.
Yeah. Well, I mean, think of what we just talked about, that Meb Faber's chart. The longest period of US no real returns in markets was 16 years. 16 years ago, the S&P and the Dow Jones bottomed in March 2009. And we've all looked at the chart and we've all seen what those markets have done since then. Imagine if they were exactly where they were. The S&P was at 666 today.
Right.
Everything that's happened since then, we've gone nowhere. That's the kind of period potentially we could be talking about, and it's the kind of period that we have seen in the past and we know can happen. Um, and so try to imagine, it's very difficult to imagine because of the contrast between a world like that and the world we've actually experienced. And of
Right.
course, if that's all you've experienced, how can you possibly think that that's possible? Because you don't know anything else.
I was going to
All
say,
you
it's
know
like
is,
almost
yeah,
unimaginable to most
yeah,
people watching
absolutely
this
right.
right now. Yeah.
Absolutely right. Yeah.
Yeah. And it's just worth noting too that, I mean, I know the average age of people watching this video because YouTube gives me demographics. Were we to have a 16-year lost, period like this, that's beyond the investing lifetime of most of the folks watching this video. I mean,
Right.
their portfolios literally, I don't want to say wouldn't necessarily survive it, but I mean, if you're 55 right now and you've got, some growth goals to get to where you hope to be able to retire, if the S&P were to flatline for a decade or more, there's a lot of people that are not going to be able to meet their retirement goals.
Well, and a lot of those people are at the heaviest weighting in stocks of their lives at the
Yeah.
time when they are about to retire and give up their income. We've become used to capital gains from bond markets, right? People have been getting great capital gains from their bonds instead of income. They've been getting great capital gains from their um, equity portfolios, and they have counted that as income. They have believed, and understandably so, because they have had this consistent reinforcement of that as an
Yeah.
idea
It's worked. Yeah.
that yeah, hey, the stock market, I get 10 to 20% income from my stock portfolio every year. I get 10 to 20% income from my bond portfolio every year. Yeah, that's pretty good. I can live like that. It's great. I can retire because I know I'm going to get that percentage return every year. Well, if you don't for a couple of years, then, oh, it's been a bad couple of years in the markets. You don't for 4 years, suddenly you're like, well, hang on a second, I might need to pull my belt then. You don't get that for 6 years, and suddenly it's like, the hell do I do now? Um, look, it's as it as it always is in investing, Adam. The art of it is trying to imagine outcomes, um, and for the longest time, the outcomes we've had to imagine have been enormously skewed to the positive. Um, what if we get this kind of multiple expansion? What if we get more QE? What if we get rates cut to zero? Um, Now those potential outcomes that you've got to try and imagine, what if we get a nuclear war, right? I'm not saying there's going to be a nuclear war. I'm not saying that. But you know what? 10 years ago, the chance was zero of a nuclear war. I don't know what it is today, but yesterday it wasn't zero. Today, with India and Pakistan fighting each other, it's higher
I was,
still,
I was just going to say, whatever it
right?
is, it's higher today than it was 2 days
Right,
ago. Yeah.
exactly right. But it's not zero. And so suddenly you've got to think about those kind of things, and you do have to think about them. It's fine to say, and markets are blithely pretty much ignoring the India Pakistan thing today because this failure to imagine that anything bad could really happen. Because generally speaking, oh yeah, it always gets sorted out before the end. And even the war in Ukraine and Russia, well, stock markets have been okay, therefore it must be okay. No, just because the market's done what it's done doesn't mean this is not a problem that at some point will explode. And when it does, all the incremental gains you've made in markets when the market should have been more concerned but weren't. That's why these things fall down so dramatically, and we get crashes because you've been climbing up in the face of a situation that merited more caution, and when it's demonstrated absolutely and without any form of contradiction that it's the bad outcome is here, you give up all those incremental gains and you go lower, and that's why we get
Lower.
the big crashes. So it's about this ability to imagine outcomes that we haven't had to imagine in our lifetimes.
So I'm glad you mentioned that. And look, we were just talking about the dangers of a flat market, right?
Yeah,
And of
yeah,
course, there could be big corrections there, as you just mentioned. To the point you're just making there, it's a great point. I listened to Treasury Secretary Scott Bessent being interviewed and about kind of his backstory, and he worked with a bunch of great investors. He actually started, I think, under Jim Rogers, but then worked really closely with Druckenmiller and George Soros, and was partnered with them when they broke the Bank of England. Um, and he attributes to Druckenmiller. They all kind of had their role to play in that. They all had their own strengths that they brought to it. And I think it was Druckenmiller who basically said, he said, what I see is my advantage as an investor is I'm able to imagine a reality that hasn't happened yet.
Hmm. Yeah.
And that's what led him to have that, incredibly successful bet against the Bank of England, which was something that nobody ever thought would be vulnerable that way. So I actually think it's a really good example of what we're talking about here. It was something that I think just everybody said, well, surely that could never happen. Druck and his team was able to imagine a scenario where it could, and they put their money where their mind was, and they actually managed to, you know, do great
Well,
on it.
that's a perfect example, Adam, because that was the last time that a central bank got punched in the face, right? 1992, 93, whenever it was, early 90s. Since then, the central banks have had it all their own way. And so
Mhm.
people assume that the central bank put is inviolable. And when the central banks say we're going to rescue markets, they're successful. It doesn't always happen. There's one thing actually that I've been thinking about recently about this, because of Scott being where he is. And I haven't met Scott. I know lots of people that know him and say he's a very smart, very nice guy. I don't know him from a
I've
hole in
heard
the
the
wall.
same, yeah.
Um, but there's one important part of this that I think bears at least thinking about with regards to the Soros stuff and Scott's background. You know, I could talk to anyone and say, oh yeah, I was a trader in the Black Monday in '87, and I navigated Black Monday in '87, and I did. I was 20 years old.
Hmm.
I had no clue what I was doing. It caught me completely by surprise. I was like a deer in headlights. Thankfully, I had a bunch of guys around me who weren't, and I was able to watch and learn from them and get advice and help from them, and I squeaked my way through it. But I don't know how old Scott Besant was when they broke the Bank of England, but it wasn't today's Scott Besant, right? And so I think we do this with everybody, from schlubs like me up to the Treasury Secretary. We go, oh, he was working with Soros. There's a different guy working with Soros. He's a different guy, uh, with different experience. And I don't know what Scott did during that particular period while he was there, um, but he wasn't the Scott Besant of today. And so you soak that experience in, and if you're smart, and he clearly is, you file that away and you call on it when you need to.
Hmm.
But I think we all do this. We all talk about what so and so did 25, 30 years ago, nearly 40 years ago in this case. And we imagine them today being in that situation. And so I think I've been thinking about that recently because of this thing about '87. I was talking to someone, they were asking me about the '87 crash. So, yeah, I said, yeah, I did. But I was some low life idiot. I didn't have a clue what he was doing. And so I learned lessons from it, but I didn't. My role in it was, we need someone to sit in the corner with his mouth open, uh, shouting, "What the hell's going on?" That was me. I'll put my hand up and do that. So yeah, it's just something that's been I've been noodling around recently. So you led me to it, so I thought I'd bring it up.
Well, and one point I'll just make off of that too, which is, I think most people would rightly take confidence to say, well, if this guy was in a similar situation early in his career and then he's become more successful, he's just accreting wisdom and he'll make an even better decision if he's faced with the same situation in the future. But I think to the point you've been making throughout this whole conversation, yeah, not necessarily. And I remember, so I worked at Yahoo, and Yahoo was a really poorly run company, and uh, us employees were eventually kind of rooting for an acquirer like Microsoft to come take us
Right.
over and other people. And Microsoft did make a bid, and famously, Steve Ballmer actually pulled his bid at the 11th hour, which broke a lot of hearts, mine especially, just from what it did to my stock options. But at one point, Carl Icahn made a play. He got on the board and he's one of these activist investors, and so everybody thought, oh, well, he's going to come in, he's going to clean up the company, and he's going to basically manage to eventually create a great premium that he'll cash out on.
Yeah.
And he didn't. He didn't. The malaise of Yahoo actually beat him. And again, we employees who were really hoping that he was going to catalyze the stock, were super disappointed by that. And so, um, just because the guy made a turnaround, in a number of other cases, doesn't necessarily he's going to make it every time, right?
Yeah, absolutely right. Absolutely
Yeah.
right.
All right. Well, look, in the time we have left, and this has been a fascinating conversation, Grant. And for folks, yes, we'll get to gold and anything else that you think sort of fits the like, hey, when you don't know much, these are good ways to play defense. And feel free to go outside of finance too if you want, and just other lifestyle behaviors that you think would be worth investing in this type of uncertain age. But on our way to there, let me ask you this: in our the past number of times we've talked about, if I've taken good notes, Grant, you were pretty confident that inflation was going to define the future. And I'm curious now, given the changes that have happened since the last time we talked, has that influenced your opinion on that in any way? Are you more confident, less confident in it? I just want to give you a chance to talk about that because I remember that as being one of sort of the things that you
Hmm.
felt you had the most confidence in going forward.
Yeah, it's still, let me characterize it how I think is correctly. It's still the thing that I fear the most. It's still the problem that I think I'm going to have to try and deal with the most. Um, and nothing I've seen in terms of the tariffs, in terms of the port blockages, in terms of all the stuff that's going on recently, has disavowed me of this idea that inflation is going to be the thing that I need to have a plan to deal with. Um, we've seen what happens in deflation. We've seen that if we get a deflationary problem, um, we know what government response is, and we've seen them do that time after time after time after time, and they will save asset prices, and there are ways that you can be okay in real terms. Inflation is a whole other problem. And what's happened since COVID and since all that stimulus was injected straight into the beating heart of the system is it has primed the inflation pump, and we've seen it break out, and we've seen it come back down to be kind of under control, but it's still 50% above the target rate,
Hmm.
despite everything that's happened. Um, could we see inflation fall? We could, absolutely. We go into recession. There are many ways where, in the short term, I think inflation could fall, and we could get maybe even get a period of not just disinflation, but maybe deflation. That's not my
Hmm.
base case. But again, I don't know any of this. I'm just trying to figure out a what I think will happen, but most importantly, what could hurt me the most. And I have felt for the longest time that um, desecration of purchasing power is the problem that we have to mitigate here, because nominal returns can be anything, but if they don't preserve your purchasing power, they're not worth a lick. You could portfolio could double every year, and you look great on paper, but if prices are going up 150% every year, you've gone backwards. And so I fear inflation. I fear what that will do. Um, and I felt for a long time, right through the deflationary period, I felt that ultimately the problem I was going to have to deal with was loss of purchasing power, and that's what led me to gold in 2003. And having that as my main problem to mitigate, and having in my head gold as a solution to that, to help me mitigate that, has worked out really, really well.
Yeah.
Not because I thought the gold price was going to go from $333 where I first bought it to $3,333 where it is today. That wasn't my case at all. The prices are relevant to me. But if inflation is my problem over time, this will mitigate it. And so I still feel like that's the problem I have to worry about, because I think if we get a deflationary period, we know what the response will be. Um, does it work? Maybe. Does it stoke the threat of inflation more? Ultimately, yes, it does, because the pumps are now primed where they weren't when we had the last amount of
Right.
stimulus. So I still think it's if it was a horse race, it would be the short price favorite, and maybe deflation wouldn't exactly be 100 to 1, but but I think it's longer odds as a long term problem to mitigate than inflation.
Okay. Yeah, you're reminding me of a comment I made in the past. Somebody had asked me, Hey, do you ever think you're going to be a millionaire? And I thought about it and I said, well, that's the plan. My fear is that by the time I get to be a millionaire, a million's not going to matter much, right?
Right.
I'll become a millionaire when it doesn't mean anything anymore, right? And I
Well, look,
imagine a lot of people watching this video probably have that same underlying fear, which is what you're giving voice to, right? Which is
well, look,
just,
I'll give you a great stat to help you out with that, right? In 2003, had you been a millionaire, had you had $1 million in the bank, you could have bought five median houses in the US. It was $200,000 was the median house price.
yeah.
Today, you're a millionaire, you can buy two.
Or you could live where I do and you can't even buy one with that.
No,
Yeah, yeah,
no, exactly right. But you know what I mean. So you're right, and this carries on much longer. Maybe you can buy one, and if you're a millionaire and you can just afford your home, back in 2003. I mean, we're talking not even the last century. 2003, you could have bought that home and had 800 grand in the bank, right? Um, that's not the same anymore, and that 800 grand would have been compounding. Not very high interest rates, thanks to the Fed, but it would have been compounding. So you're right. You could be a millionaire and maybe you can't afford to buy a Ford F-150.
yeah. I remember seeing an article. I mean, this was years ago. It was not a recent article, and it was about people who had noticed that their retirement account had crossed $1 million. Right, so people have been working for decades and putting money away, and they open a statement. Wow, we're technically
Yeah.
millionaires, right? And the gist of the article was most of these people were like, oh my life doesn't feel any, I don't feel like I can afford anything more than I could, last year or the year before. Like it just was sort of like it's this milestone I've been pursuing my whole life, but now that I've hit it, I'm realizing it's not game changing in the way
Well,
that I thought it was going to be.
I've got a great story for you in this, actually. So our mutual friend David Hay, I was speaking to a group of his clients back in 2012, I think it was 2012, and I put up a chart um, which had two bars on it, and one was the interest on $10 million if you just parked it in 2 year treasuries
Hmm.
in 2007, and you were getting $500,000 a year in interest on your $10 million of treasuries at 5%.
Yeah.
And I then put up the bar of interest on that same 2 year treasury where we were in, I think it was 2012. 2012. It was $13,000.
Right. Because we weren't maybe quite at ZERP, but we had started the QE
We were
program.
as near as damn it. And
Okay.
so a guy came up to me afterwards, lovely guy, and we stood there chatting, and he said, you've just crystallized something that I have been unable to figure out. And he and his wife had a business which they'd sold, and they'd been building this business for years, and they always said that if we can ever sell this business for $10 million, that's us out.
We'll
We're
be set for life.
retired. And he said, we did. We sold it, and we're having to eat into our capital. And I just don't understand what's happened. I can't understand what's happened. And it says, I mean, it perfectly illustrates your point that these nominal gains are not so important, and the nominal number is not so important if in real terms, which is why in my head that's the big bugbear that I want to make sure I'm thinking about offsetting. You don't keep up.
Great. It's a phenomenal story. So, okay, just to try to land this plane. So change is coming. It is going to be disruptive. And if I remember the term you used early on in the conversation, odds are it's going to be destructive change for all the reasons we talked about for these types of turnings. Um, it sounds like one of the things you have the greatest confidence in is that loss of purchasing power of fiat currency is going to continue. And we can argue whether it's going to accelerate or not, but at least the trend is going to be downwards. Um, with those sort of the parts that we know, what should folks consider doing to reduce their chances of becoming collateral damage to this change? And maybe if possible, go there only if you want to, are there things we can do that might even increase our odds of coming at the other end even better?
Well, look, I mean, the late great Richard Russell famously said that in a bear market everybody loses, and
Hmm.
whoever loses the least wins. And that's the mindset. That's the switch, right? And again, another great story. Um, I have a great affinity for Charleston, South Carolina, and
Beautiful
it's a
town.
beautiful city with so much history there, and obviously it's where the first shots were fired in the Civil War, and there's just so much history in Charleston. And there's a place in Charleston called the Calhoun Mansion, which is the biggest house in the city, and it was built by a guy called Walton Williams, and it was built after the end of the Civil War. And Walton Williams was a gun runner, George Walton Williams, and he was a gun runner, no relation. And he would run guns to both sides, but he would only accept payment in gold and silver coins. He wouldn't accept dollars. He wouldn't accept Confederate dollars.
Yep.
He'd only accept gold and silver. And so he amassed a ton of gold and silver from his exploits. The Civil War came. He made a load more, I'm sure, during the Civil War. And of course, the Civil War ended, and the Confederate dollar went away. And George Walton Williams became the richest man in Charleston. He bought all the banks. He built this massive house, um, and he became the richest man in Charleston overnight. Not because he got rich. He wasn't any richer after the end of the Civil War than he was before it.
He just
Everybody
didn't
else
get
got
poor.
poor.
Yeah.
Everybody else got poor, and it's a mindset that we're not used to thinking in because we've watched nominal gains, we've watched
Right.
appreciation, we've watched. So it's a relative gain. So to sit and to have a mind that says, okay, I want to make money out of a bear market. I'm not saying you can't do it. If you're good enough and nimble enough and you lucky enough and you get in the right places, you can absolutely make money in a bear market. Some the best traders in the world will do really well in bear markets. But going into one, if you think this is a bear market, if we think the change we're talking about, the kind of change we're talking about, is going to be dangerous for risk assets and is going to create downward pressure on prices for the first time in a generation and a half, then this becomes about not getting poor. This becomes about staying where you are, protecting what you have, resilience. You used that word earlier, and we keep coming back to
Yep.
that, becoming resilient against the forces that are going to confiscate your wealth. And at the end of it, even if you don't make money, if you lose 30% and everybody else loses 50 and prices go down 70, you are going to come out smelling of roses. And this is exactly what gold did actually during 2008, March '08, when Bear Stearns fell. Um, the gold price initially fell, and everyone was like, "What the hell's going on? Gold's supposed to, save me in times like this." Um, when the S&P had bottomed, your purchasing power in terms of units of the S&P you could buy with your 1 ounce of gold have gone up 66%. So the gold price didn't go crazy, but you could buy infinitely more of the things that you wanted to exchange that gold for because holders of the S&P got poor and you stayed where you were. And so it's a very different mindset from what we've been able to have for the longest time, for most of our investing lifetimes. And it's a tough shift to make, but I would think the sooner you find a way to make it, or the sooner you find a way to at least consider it, the better off you're going to be in the long run.
All right. I'm going to ask you some specific questions and then we'll wrap up.
Shoot.
But real quick, you mentioned Richard Russell, and I had the great privilege of meeting him in the last year of his life. It's an interesting story, which I don't have time to get into here, but in the conversation, and Grant, I actually have a really poor audio recording of that. If you're interested, I'd be happy to send you.
I'd love to hear
Um,
that. Yeah.
and he saw this type of change coming. So this was, I'm trying to remember when this was. It was about 10 years ago.
Yeah. Yeah. About
Um,
10 years ago.
and I mean, he was referencing, the exodus of people out of Europe, sewing, um, precious gemstones into their clothing and whatnot,
Yep.
right? I mean, he was seeing this type of like, there may be a period here where you just want to, find ways to tangibly hold your wealth and last whatever the corrective cleansing is going to be, and then re-enter, right? So even back then, he was concerned enough about this to be talking about it literally in the last days of his life. So anyways, to steal the old Rothschild quote, what you want to do here is A, survive, but B, have some dry powder so that when there is blood on the streets, um, when you can buy true value at much lower prices than you can today, that's where maybe the prospering part of this comes, right? I agree with you. It's a low probability to be able to finesse a bear market in general because you have to get so many things right. But to get a correction of the magnitude we're talking about correct when there's going to be zigs and zags all along the way, your short bets might be working out great, and then they might get completely zorched with a rip your face off bear market rally. And so you might be right conceptually in the long run, but killed a number of ways, on the way there. So that the real safer bet just seems, hey, play it safe, keep your powder dry, minimize your risk, and just live to fight another day when the sun comes back out at the end of all this.
Yeah, just be smart. It's been okay to be gung ho for a long time. The markets have bailed you out, the central banks have bailed you out, governments have bailed you out. Um, it's not as clear that you can just be gung ho, and you may be great. The famous chart of a turkey's life, right? You have 364 terrific days, and then boom, um, and
Only
that
one bad
boom,
day just happens to
yeah,
be the
right.
last one. Yeah.
But that's the end, and so those boom days, and I don't mean boom as in boom, great, everything's great. I mean those boom days um, are going to come more often, and they will be much bigger in terms of their effect, and so they'll be tougher to recover from. So, yeah, look, there's time to make hay, and there's time to get yourself prepared for the winter, and I think now is the time to do that. And I think it's been, talk about Richard talking about that 10 years ago. And people say, well, he's been thinking about this 10 years ago. He wasn't hiding under his bed, with all his money in cash in a box under his floorboards. He was still doing his thing and investing, but he was understanding where we were going. And we've talked about this at the beginning. These cycle, even the end of the cycle, the fourth turning, as Neil describes it, can be 25 years long, right?
Right.
So being 10 years early, it doesn't mean you were in the fetal position for 10 years. It means you entertain these possibilities, and in the back of your mind, you had a feeling that there's the period where we're going through. These are the problems I have to mitigate. I'm making money here, but I'm also creating a framework which will protect me when this finally manifests itself in a way that nobody can any longer deny or ignore.
Right. And it's important to remember that the developments of a fourth turning are exponential. They're not linear. So when you
And
say we're halfway
climactic.
through the fourth
And
turning, people are
climactic.
like,
Yeah.
yeah,
Yeah.
they're like,
I
oh,
mean,
if we're halfway
that
through, then, this isn't so bad so far. Well, it's like, well, wait a minute. The action
exactly
hasn't
right.
really started yet. Yeah.
Exactly
Okay.
right.
So in terms of protecting yourself, and I know, everybody's personal situation is different. There's so much that we don't know, but clearly gold, you think, is one strategy for preserving purchasing power of capital. What are some other things out there? I mean, there's obviously, if you're going to continue to play in the financial markets, maybe relying more on hedges going forward. Maybe it might be, hey, invest in a business, something that creates some income stream, so that as if times get rougher, but you can keep the business going, at least you've got some income coming in. I mean, what are some of the things? Are there other things that you think are worthy of considering for people that are trying to just say, okay, great. So how do I make it through this coming change safely?
I think we talked about this last time, and what you talked about there about businesses is an important part, and we'll come back to that in a second. I think the best advice I can give people for this is take less risk. If you want to survive this, take less risk and take smarter risk, um, because the risk reward situation has changed dramatically, and it might not be obvious at the moment, but it will become obvious. So you've been able to take the kind of risks that make sense in a market the likes of which we've had, which is strongly bottom left to top right, central banks with loads of room to help you out, et cetera, et cetera. We all know the things behind them. So it's been appropriate to take bigger risks. I don't think that's the case anymore. So you need to understand the nature of the risk you're taking, and how much risk you're taking, and whether you can stomach it, and whether it's smart risk. Um, and that goes for anything in the financial world, anything that's financialized. Uh, there is a risk to that, because you can get revalued and taken out by other people's reactions to the same idea that you've got on, because there's a publicly traded market for it. And that's what brings me back to this idea of businesses. The beauty of investing in a business, which is what this used to be about. Nobody bought stocks; they invested in companies. The mechanism by which they did it was the same, but the mindset is incredibly different. If you're buying stocks, you don't really care what the company's doing. You think the stock's going to go up and you're going to sell it for a profit. If you invest in a company, you want to stake in that company's cash flows and its future. It's a very
Hmm.
different mindset. So investing in businesses, and if you can invest in businesses that you know and you understand, and importantly are not quoted publicly, you give yourself a tremendous chance to not only survive this but thrive through it. You pick the right businesses that are recession proof. You pick the right businesses that are well run, well managed companies with low debt, with a solid customer base, a solid product that is, if not recession or inflation proof, it is certainly resilient to those things. There's that word again. Um, you don't have to go through the daily torment of having to revalue mentally
Right.
what you own by 10, 15%, because the market is a big drawdown. Um, a good friend of mine was recently visiting a company that he owns. It is a publicly traded company, but it's in a tiny European country. And he went to see the company, as he does every year. And he said he came back just enraptured about what this company has done to its business in terms of increasing the scale of the business, the efficiencies of the business. He said, this business is 6 times bigger and better than it was 5 years ago, and the shares are unchanged.
Hmm.
And at some point, that will be reflected in the share price. He doesn't care. He's not looking at the price. He's looking at the business, and what they're doing to this business makes it incredibly valuable. I don't care what the share price is doing. Um, that is a publicly listed company, but if it wasn't, it wouldn't matter. He'd be looking at this business going, man, what they're doing is tremendous, and the cash flows are going to increase, and the bottom line and my ownership in that business is going to be a lot more valuable. And so, again, it's a very different mindset, because it requires work, and it requires something a little bit more than reading an article in Time magazine, thinking, oh, what a great idea. What's the ETF that expresses that idea for me? I'm
Hmm.
buying the ETF, right? That's worked for a long time. It's been a great way to make returns. In the world we've talked about for the last hour, that is no longer the smartest, least risky thing to do. And that's going to be a sea change for an awful lot of people.
All right. It's a great point. The only thing I'll add to that is the in terms of your point about smart risk is investing in starting or investing in private companies, depending on their size. Another advantage you have that you don't get in a public company is a public company is big and you have got no ability to influence it.
Yeah.
But if you're starting your own company or you're buying into a company at any real scale, you've got the ability to actually have some control and some say in how the company is managed. And that you got to be good and smart, but that gives you an additional benefit that you don't get in the public markets. All right, Grant. It's been fantastic. I'm looking at the time and I got to let you go, but there's so much more I wish we'd gotten to. We'll just get to next time. If I can, let me just ask you, let me make a comment and then ask you one question I wanted to ask you when we first started here. Um, Comment is, I was during the conversation, I was trying to think what's different about you. And I just realized it's the beard. You shaved the beard off. And
It comes and goes. It comes and
man,
goes.
you look very young for a gentleman of your age.
Of
And
my advanced years. Well, that's very
yes,
kind. Thank
exactly.
you.
You look a lot younger than me. You get a few years on me, and you look a lot younger than me. And you're thinking maybe I need to shave this white off here.
No, there you go. Or just dye it black. I'm sure you can get stuff for that now.
Yeah, yeah, exactly. It's funny. The last time I shaved it off, my daughters were much younger, and one of them, when I came out of the shower, said, "Oh, Dad, I said I wanted you to get rid of it, but now that I see it gone, your face is a lot less interesting." So
Okay.
beard came right back.
Thanks, Stu.
Parting question here is, you and I have bonded in times past privately over our love for music, particularly earlier rock bands, rock bands of the 60s and 70s. Um, what's just one or two bands that you think everybody should have in their music collection?
Do you know what? We could talk for hours about this, Adam, as we have in the past. But I'm gonna give you I'm gonna give you one just because I want to
Okay.
focus
And there's
everybody.
no
And
wrong answer here. It's just,
no, no, no. I know. There's there's a young English singer songwriter. Um, Definitely not rock, as you and I have talked about in the past with great affection. He's a young singer songwriter. His name is Louis Dunford, Dunford. He grew up in North London. He's a big Arsenal fan, coming back to football again, and he wrote a song called "The Angel," North London Forever, which is all about him growing up in and around Arsenal Football Club and the characters he met on the streets. And that song became the Arsenal Football Club anthem. They play it before every game now, and
Oh,
it's
wow.
so there's a story. But he's lived a tough life for a kid as young as he is. He's probably in his late 20s. You know, his best friend was stabbed in the street and died in his arms, and he wrote a
Oh, geez.
beautiful song about that called "The Ballad of Benjamin," which I to this day am unable to listen to without a tear in my eye. It's just a
Mm.
beautiful song. Um, but his songs are incredible pictures of life growing up in as it happens North London. But for anyone of his generation, they will recognize some of these lyrics. They're funny, they're brilliantly written, the music's great. And I went to see him a couple of times actually recently. I was in the UK and I saw him in Scotland, in Glasgow, and I saw him again in London. And two of the best concerts I've ever been to. And I've been to a
Did you
lot of
see him
concerts over the.
relatively recently? Because I remember you
Yep,
putting an X post out recently about a
yep,
wonderful concert you were at. That was it?
yeah. I saw him. Would have been last month. Once in
Okay.
Glasgow at the
Yeah.
Barrowlands, and once in London at the Alexandra Pally, the Ali Pally. And he is such a talented songwriter. Um, I recommend him to absolutely anybody. And if you can't find something in those songs, whether it's the lyrics or the music or just the stories, I you have no soul, and you can quote me on
Okay.
that.
So I wrote it down correctly, Louis Dunford.
Louis Dumford. Yep.
Okay. All right. And Grant, folks just watching you express your appreciation for him so emotively and articulately, um, you know, folks can understand why you're such a musicophile. So I'm obviously going to go check him out as soon as we finish up here.
Good man.
All right, folks. Well, look, if you've enjoyed this conversation even half as much as I have, please give Grant a huge thanks by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Grant, for folks that would like to follow you and your work, where should they go?
Very easy. Grant-williams.com. Everything's on there. And if you want to follow me on Twitter for any reason, you'll find me at TTMYGH.
All right, great. And Grant, I will put up the URLs to both your website and your X handle on the screen
No
there when I
problem.
edit this, so folks know exactly where to go. Folks, the links will be down right below this video as well. All right, Grant, stay just move for 1 second here while I do some quick housekeeping. Grant has made a very compelling case for why change is afoot and likely to get more disruptive as time goes on here. We talked about some strategies, some general strategies for how to protect yourself. Um, you know, Grant, most of the people who watch this video, we do have some professional investors, but a lot of them are just regular people, right? They've got regular lives, jobs, families to focus on. Again, they just don't want to become collateral damage. So, to those people, I highly recommend that they don't try to figure this out on the fly, that they try to find a good professional financial advisor who either has some vestiges of some of the scars like a veteran who's lived through some of the more tougher times in the markets that we haven't had for a long time, or at least has studied them and takes all these macro risks that you and I talk about into consideration. Because when you lay out those requirements, the universe actually gets pretty darn small, right? So
Yep.
folks, if you have an advisor who meets that criteria and is helping you out, fantastic. You should stick with them. But if you don't have one, or you just even like a second opinion on your current portfolio from one that meets those requirements, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To set up one of those consultations, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds. These consultations are totally free. There's really nothing to lose. You'll just get their professional advice on what they think you should do after they learn about your personal situation and your goals and your risk tolerance and all that. So have at it. All right. Thanks for hanging with me here, Grant. You just heard my description of the general audience here. Any parting bits of advice for these people as we let them go? Obviously, they're going to go listen to Louis Dunford in a second, but if they're a little bit shell shocked from the greater conversation we had, again, any parting counsel to them?
Um, yeah, let me think. Well, look, I think if you are shell shocked by what we've just talked about, Adam and I, for the last hour, then that's the single biggest sign that you need to think about this stuff. Because as we said, this is a slow moving change that's picking up speed. So all of the stuff we've talked about has been a clear and present danger for some time now, but it's been small and it's getting bigger by the day. So if this shocks you, if it feels overly bearish to you, if it feels like doom, um, then you really need to spend some more time thinking about this, because I completely understand why that would be, because everywhere you look there are bullish predictions about markets that go up, and then markets go up, and so people say, well, look, the bulls are right, the bears are wrong, uh, and that's been right, but there's a period at the end of these runs where the markets are going up not for the reasons you might think. It's just exhaustion. And it
Mhm.
feels like we're in that place now. So if this seems dark and it seems despairing and it seems scary, that's the best sign I can give you that you need to understand it better. Because if you understand it better, it won't be that scary. It'll be something that you need to navigate, and history will show you many ways that you can do that. And so it's important first to recognize the problem. And I think conversations like this, Adam, and kudos to you for being willing to have them. A lot of people won't. They just want people who are going to come and say why everything's great and the market's going to keep going up.
Mhm.
Conversations like this are the place to start, to just listen to boring old grey haired guys like me, and at least think about what we have to say. And if you think it's nonsense, I'm perfectly used to that and won't be offended in any way, shape, or form if you ignore it all.
No, very well said. Well, thank you so much for coming on here, Grant. And the only thing I'll add to what you say is, don't forget Grant's message too, that if you navigate this well, there's a lot of opportunity on the other end,
Oh hell
right?
yeah!
So it's not all doom at all. Anyways, Grant, it's always such a pleasure. Thank you. This was no exception. I want to reiterate my eternal respect for you and what you do. In the world of financial media, you are indeed the gold standard that the rest of us aspire to. Thanks for blazing that trail, for doing everything that you do. And again, thanks for sharing your time today.
You're very kind, Adam. Overly kind, but it's always a pleasure. Thanks for having me on.
All right. And everybody else, thanks so much for watching.